Most people believe wealth is built by making smart decisions at the right time. They assume speed and intelligence create an edge in markets. This belief pushes people toward constant action. One simple rule quietly challenges that entire mindset. Most investors begin their journey with the same expectation about success. They believe better outcomes come from doing more than others. This belief creates pressure to act frequently. Pressure is where long-term mistakes usually begin. There is a rule that shaped decades of disciplined investing decisions. It does not focus on finding big winners. It focuses on avoiding irreversible damage. That shift changes how every decision feels. The rule sounds almost too simple to matter. Many people hear it and move on quickly. Simplicity often feels unimpressive, yet simplicity is where discipline survives. The foundation of the rule is protecting what you already have. Growth becomes meaningless without survival. Large losses permanently change outcomes. Avoiding them becomes essential. Losses affect behavior far more deeply than gains ever do. They create fear that lingers long after recovery. A single deep loss can influence decisions for years. This hidden cost is often ignored. Recovering from loss is not balanced or fair. Losing money requires more effort to regain it. That effort usually demands higher risk. Higher risk introduces instability. This is why capital protection comes before opportunity. Opportunities appear endlessly in markets. Capital is not easily replaced. Time lost is even harder to recover. Many people misunderstand this rule completely. They believe it means avoiding all risk. That misunderstanding leads to paralysis. The rule is about selective restraint. Markets constantly test emotional discipline. Rising prices create confidence and comfort. Falling prices create fear and urgency. The rule exists to stabilize behavior. During optimistic markets, caution quietly disappears. Recent success feels permanent and reliable. Risk begins to feel invisible. This is when discipline matters most. During market declines, fear becomes overwhelming. People sell not because value changed. They sell because discomfort feels unbearable. The rule separates emotion from reality. This rule encourages fewer decisions rather than more. It values patience over constant movement. Waiting feels uncomfortable in noisy environments. Discomfort often signals discipline. Many investors confuse movement with intelligence. They believe activity equals control. Unnecessary action increases risk. Stillness often protects capital better. Complex ideas often feel safer because they sound intelligent. Complexity hides fragile assumptions. Fragile assumptions break under stress. Stress exposes hidden risk. Simple ideas are easier to understand and monitor. They behave more predictably over time. Predictability reduces unpleasant surprises. Surprises are where losses live. Diversification is often misunderstood as protection. Owning many ideas without understanding them is dangerous. Ignorance multiplied does not become safety. Quality matters more than quantity. True protection comes from clarity and restraint. It comes from saying no repeatedly. It comes from ignoring urgency. Urgency rarely aligns with long-term success. News and headlines constantly demand attention. They create the illusion of importance. Most of this noise has no lasting value. The rule filters signal from distraction. Time is the most powerful force in investing, but time only works if compounding continues. Large losses interrupt that process. Interrupted compounding changes outcomes permanently. This is why capital protection comes first. Growth depends entirely on survival. Survival allows time to work quietly. Time rewards patience more than brilliance. Beginners often focus on how much they can make. They rarely focus on how much they could lose. This imbalance creates fragile strategies. The rule reverses that focus. Thinking about loss feels pessimistic at first. In reality, it is practical and responsible. It prepares you for uncertainty. Preparation reduces emotional reactions. Preparation happens long before volatility appears. It occurs during calm and boring periods. Discipline is built in quiet moments. It cannot be improvised later. Many people attempt discipline during crisis. That effort usually fails. Emotions dominate under pressure. The rule must already exist. Regret plays a powerful role in investing decisions. People regret missing rallies. They regret selling too early or too late. The rule reduces regret by focusing on process. Process matters more than outcomes. Outcomes are influenced by luck and timing. Processes, repeatable and controllable. The rule strengthens process. Overconfidence often follows periods of success. Gains are attributed to skill alone. This leads to larger risks. Larger risks threaten capital. Humility is built into this rule. It assumes uncertainty always exists. It accepts the possibility of being wrong. This mindset protects against arrogance. Applying the rule does not eliminate opportunity. It filters opportunity carefully. Only ideas that survive scrutiny remain. Fewer decisions often lead to better results. This approach often appears boring from the outside. It lacks drama and excitement. Boredom is often a sign of stability. Stability supports long-term growth. External opinions constantly create pressure. Friends, media, and online voices compete for attention. Listening to all of them creates confusion. The rule simplifies decisions. Capital represents time, effort, and sacrifice. Careless risk disrespects those costs. Protection shows respect for resources. The rule enforces that respect. Beginners can apply this rule by slowing down. Smaller decisions reduce emotional stress. Understanding replaces urgency. Safety grows through restraint. Learning before acting reduces costly mistakes. Observation builds confidence without exposure. Experience grows without loss. The rule supports learning first. This rule does not guarantee success. No rule can remove uncertainty. What it does is prevent ruin. Avoiding ruin is essential. Over long periods, this mindset compounds quietly. Compounding rewards patience more than intensity. Consistency matters more than brilliance. This is how durable wealth forms. Markets will always test discipline. They will tempt and frighten repeatedly. The rule remains unchanged. Consistency is its greatest strength. This philosophy guided Warren Buffett for decades. It emphasized survival before expansion. It rejected urgency in favor of patience. That mindset created extraordinary consistency. In the end, investing is about behavior more than intelligence. Markets reward calm discipline. Quietly, the rule protects you from emotional decisions. That protection becomes the foundation of lasting wealth.